Hey, what is up everyone? It's David here. I'm trying to be more open-minded towards technical analysis and broaden up my investing skill set. So, I spoke to Michael from Demoniaco ASX to learn more about the topic, and this video is all about the fundamentals. The two examples we looked at is Polynovo and JBH, and timestamps are in the description box below. But before I get started, no, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. If you do need help with investing, make sure you go see a licensed professional. Without further ado, let's go! I thought a really good place to start is actually getting to know you a little bit more, Michael. So maybe help us understand a little bit more about your background and how long you've been day trading for.
Sure. So I've been involved in the markets since around 2013, 2014 is when I first started. I was doing swing trading to begin with. I was doing it while I was working. And eventually I made the move to day trading in 2015. So I've been full-time ever since then. And I haven't really looked back. My focus is primarily on technical analysis for the larger cap stocks and a mix of fundamentals and technicals for the smaller cap and micro cap space.
Did you always had a background in economics and
No.
So this is like self-taught?
Yeah, 100%. So I started because I actually took my money to the bank and I said, look, if I don't get a better interest rate, then I'm out. And I actually went through with my threat. You know, I told them, what was it? It was like 4%, 3.5%, whatever it was. I told them, look, it's not even meeting inflation. I'm losing money here by having my money in your bank. So I made the threat. I had no plan because I thought they'd give me a higher rate. So I just took my money and bailed. So I'm carrying around in my in an envelope. They put it in an envelope for me. It was like 30 grand in like 2 envelopes. And then I just went to the next bank and I thought, all right, I just need to put my money here. So then I figured, what's the best way to actually make money with money, right? Because I don't want it sitting in the bank. That's a terrible return. And that's where I started looking at trading. So that's how I got started.
In our private conversations, we talked a little about the risk management aspect of trading. I want to kind of dig into your perspective a little bit more on that.
Yeah, risk is everything. I don't care what anyone says. Risk is your everything. That is what you should think about in the morning, in the afternoon, when you execute a trade, when you enter a trade. Doesn't matter. Risk is everything, and managing that risk is so key to success that pretty much I don't like calling myself a trader anymore. So when people ask what I do, I even changed my Twitter bio. It's risk manager. That's it. So people see stocks as gambling, but what they don't realize is you can mitigate your losses. You can use technical analysis to define your entries and exits, and it can define risk, right? If I told you right now, if you had 5 grand spare, and if I told you on this particular trade, there is a high probability setup, it's greater than 50%. Let's say it's somewhere in the ballpark of 70% likelihood that you could make anywhere from 10 to 20% profit at the risk of 3% loss. Would you take it?
Expected returns sounds pretty decent.
It's extremely good, right? That's so when you have risk management like that, you can afford to be wrong 35% of the time and still be profitable. Not much, but you can still be profitable. So the idea is to take the best possible chart setups, get the best possible entries based on the chart setups, and define your risk. If something has set up in such a way that you can have 5% risk and potentially 10% gains or more, you can be wrong so often that it doesn't actually matter because you're managing risk. And that's the hardest part is no one teaches you how to lose in life. You learn any sport, you go do anything. It doesn't matter what subject, mathematics. You're never taught to lose or how to lose. You're taught that winning is great and that's what you should strive for. And while that's true in the markets, losing is half your life, right? So how do you manage losing? That's something that nobody's ever taught you. I guarantee you nobody's taught you how to lose. But this isn't a game, this is your livelihood. So, you know, what was your previous job, David?
So I worked at a VC fund startup. So it was like basically spending out investors' money to make money.
Right. You had to win. In this game, in this environment, losing is half of every day, half of every week, half of every year. You look at some of the most profitable traders on the ASX, some of them have 45% win rates. Some of them have 55. It's usually in that ballpark, give or take 5% from the 50% mark.
Let's jump into technical analysis at this point. And I thought a really good place we could start off with is what tools do you need and some of the basic settings like, I'll let you take the reins.
Sure. So when we start with technical analysis, the absolute core basics are your trend lines. Your trend lines, your horizontals, these define levels of resistance and support. And I think before I go into this, I know there's going to be a few viewers of yours who are going to be skeptical of technical analysis. And I just want to quickly define what technical analysis is and what it is not, just real briefly. What technical analysis is a visual representation of human psychology. People react differently. There are different subsets of people that will do different things at different times given different scenarios, right? So here's an example. There's a subset of people that'll buy a stock at a round number, like $1, and they'll sell a stock at a round number like $2, which is why at every $2, $2.50, $3, all these round numbers, you'll see big walls in the order book, right? That's part of human psychology. There's a subset of people that do these things, hence why you see large orders at these levels. So technical analysis is not a crystal ball. So if I draw a trend line, a horizontal trend line like this, let's say there was a historical level, it does not say that if this stock hits this trend line, that it's all over and done for, right? It's not a crystal ball method. What it is I can now define my risk. That if this stock goes above this support level and comes back down to retest, this is one of my favorite chart setups of all time, is breaking a level and then buying the retest. So we can see here, the stock broke out, came back down on this candle. That'd be a perfect entry. Just a little bit above the trend line, perfect entry. Your risk would be just well below by 5-6 ticks, depending on the stock. You can almost eyeball how much risk you're willing to give it. Now, you can give this about a couple of percentage points of risk, and then you can let the stock rally. And we'll talk about exit targets a bit later, but we're going to talk about entry targets first and foremost. Now, what you can also do is you can buy a stock at a support level. So when a stock comes down, we can identify a trend line here and we can buy into it. And here's an example, a perfect example of a stock that's failed at support, right? You'd be buying into this stock at about 265, and you'd make a loss on this one at maybe 255, right? 10 cents risk. The upside would be towards the upper end of this range, right? 325. So there's your risk to reward. This much to gain that much.
Right.
And the idea behind technical analysis is that people respond differently to different levels. And what we have here is a support level. People will see this trend line as well, because trend lines are the absolute basics of technical analysis.
Right.
And if people are interested in the stock, they'll also buy at this level. Now, when a stock fails at major support and major resistance, it usually does so on high volumes. So we can see here on this breakout where it went to the upside, is there was a higher candle. And we can see the selling, I think this one's a little bit obvious because it shot down so sharply, is the selling has all been quite high volume. Now, with technical analysis, volume is the second most important. Actually, I'd probably put it on equal par with trend lines and horizontals. Volume tells you everything you need to know, whether a breakout is successful, whether there's interest in a stock. If a stock broke out on low volumes, I'd be raising some red flags. I wouldn't be interested in that stock. Like I said about the resistance levels, you know how I said about $2, $2.50, and $3 having key levels for psychology? Same thing with trend lines. People are going to pile on at this $3.26 level. They're going to pile on their sell orders to try and get out. And if that breaks on high volume, you've suddenly got a momentum swing. Now, there's now, to clarify, there's going to be a certain subset that will buy as it breaks out, whereas I personally am the subset of people that buy here, where it's right next to the support level. I never chase a stock.
Retesting?
Yeah.
Okay.
I'm the person that buys the retest because the difference between buying here and buying here is quite simply I have less risk, more reward compared to the person who bought higher than me.
Okay.
So that's the absolute core foundation behind any stock is your trend lines.
If I could just quickly summarize, so basically technical analysis is a visual representation of human psychology. That's basically what, like, at the core.
100%.
And volume, support, and resistance defines the risk and the benefit.
Yep.
Okay. And then especially when you have high volumes, that's when a positive high volume is when momentums will start shifting. But low volume might indicate that, hey, maybe this is just, short term.
Correct.
Okay,
No,
cool.
Yeah, 100%. Now, when it comes to other indicators, there are only a couple that I would ever suggest anyone to use on a daily basis. There's hundreds of indicators out there. And they're all kind of the same thing as well, or they can be. They form a part of different groups of technical analysis. For example, the most common ones we know of are the MACD and the RSI. Now, the MACD and RSI are both oscillators. They do the exact same thing. They tell you the exact same information in different ways. So for me personally, I look at the MACD as a tool not for enter and exit positions, but for divergence. Now, divergence is something that isn't very commonly used amongst traders, and I think it's very underutilized. So people know about the MACD, but they don't really know about how to use divergence or how to use the MACD effectively. So let me bring up the indicator of the MACD. And you can do the same thing with the RSI. It's the exact same situation. The idea behind divergence is a stock will go in one direction, for example, up, and the MACD will go in the opposite direction and it'll go down. Now, in this case, there's no negative divergence. So what I'll go through is I'll have a look at something like JB Hi-Fi and see if I can... Here we go. Perfect. Now, we have a stock here that was attempting to make a new high. And what we have here is a negative divergence. So the stock is either going sideways or up, and the divergence is going down. Now, the MACD is a visual representation of price action. It shows how strong the buy pressure is or the sell pressure. So the way you could, I guess, explain this particular indicator is at the top here, we had a certain amount of buying to hit this high.
Right.
And then as it swung back up, it had less buy pressure. So there was less volume. It's basically a visual representation of volume. So you could actually look at the volume bars and it'll tell you the same thing, but it's a little more difficult to see. So we have the oscillator, which is the MACD or the RSI, and it'll tell you the exact same information in a visual form. So that's what the oscillators do. Now, in terms of the actual oscillator, I use that as information. I never make decisions based on the oscillator by itself. All it is information, because what can happen, and it certainly happens quite often, is it can rally, pull back, rally, and it can just keep going lower and lower and lower and lower the MACD. That can happen for sure. It can do it 3 times, 4 times, it doesn't matter. But the information that you're getting is that every time it goes up, there's less buy pressure. Therefore, it's less likely to continue to the upside. So then you could look for targets for where to close out your long position.
So essentially, if the chart keeps going upwards, but the divergence is negative, and then it just really means that the price action is losing momentum. 100%. And then you have to make a decision on when you want to exit.
Absolutely. Okay. And I guess speaking of simple moving averages, this is also one of the most common tools. Personally, do not like simple moving averages for my short-term trading and for my day trading. They're terrible tools to use for that sort of short-term environment because these things are smoothed and averaged out and they're based on historical information. So if I bring up, so here we go, here's the moving average. And all that tells you is a moving average of 9 is the average of the last 9 candles. So really, if I was to move this, let's say, change the settings, a really common one is 100 moving average and the 200 moving average. So if we do 100, let's say 50. The reason I don't like it is because people tend to do crossover. So, when a stock hits or goes below the 50 moving average, they sell out, or the 100 moving or the 200 moving. And I think that's an incorrect usage of simple moving averages. All it tells you is that it's trending to the upside, right? I don't think one needs the simple moving average to tell them that it's going in an uptrend. I think one can look at this and go, yeah, it's trending up. So simple moving average really is a tool that's very commonly misused amongst short-term traders and especially day traders. So yeah, as for long-term investors, which I imagine a lot of your traders are or investors are, would probably be looking at the 200 moving average. Now this one actually shows some level of support and resistance as well. This is a very commonly used tool amongst investors, and really all it is it tells you that it's in an uptrend over the last 200 candles. Now, another technique is to bring up another moving average, and we'll put this one to 50. Now, this is a technique, I believe, used by Mark Minervini. He uses the 100 moving average, the 50, and the 200. And what he suggests is if you're looking for a long-term investment, you want something that is 30% higher than its absolute lows. You want something that is with the 50 moving average above the 200 moving average. And trade that because it's in an uptrend, right? So if any of your viewers are interested in really high quality technical analysis, I strongly recommend Mark Minervini, Trade Like a Stock Market Wizard. It's got a really unfortunate book title, but it is the best one I've read by far.
So thank you so much for watching this video all the way to the end. I have learned a lot about technical analysis from Michael. I'm hoping that you did as well. If you did learn something new, consider gently smacking that like button right there. Subscribe to my channel and click onto the bell so that when I release future videos, you'll be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.